Welcome back to the channel. Thank you for tuning in. So, today I want to show you an easy everyday ICT model. I don't like using the word strategy, but for the sake of uh, you understanding me, I want to use the word strategy. But actually, what I call them models. So, a model is basically a set of rules that that have to be engaged with, I guess, before you check a trade, basically. So I don't like to use the word strategy. I prefer using model. So I want to show you an easy everyday ICT model that you can use um, to take advantage of what is happening in price. So during the New York session, you want to identify a stop rate. You want to wait for a market structure shift. You look for a favorable gap to use to get in sync with price, and you target untapped liquidity. So obviously, if you are very new to um, ICT concepts, a lot of things are flying over your head right now. So I'm going to repeat for the sake of completeness. Ne? What I mean when I say identify a stop rate, you need to see liquidity being, again, I don't like to use this word, but you need to identify liquidity being grabbed. So either sell side or buy side liquidity, you identify it being collected. Ne? And then obviously on the opposite end of the liquidity, there will be a swing high or a swing low. So when that gets taken out with displacement, that's what we call a market structure shift. So it's basically when price takes out a swing high or a swing low with displacement after collecting the opposite end of liquidity, previous liquidity, and then you enter the fair value gap. So a market structure shift cannot be a market structure shift without a fair value gap. So I'm gonna open the chart for you. So I'm looking at US 500. I will be looking at the New York session for the day. In other words, the the AM New York AM session that we just had. So as you can see, the time is 1:30. I will be looking at between 9:30 and 12 o'clock for this video. So before I begin, I want to show you just a clear naked chart so that maybe once I put once I close it with lipstick, you can appreciate the amount of detail that I'm sharing with you on this channel. So we have here a clear naked chart. Now, if you're new to this concept, you might be tempted to go in there and start putting support and resistance levels all over the chart. We don't do that here, right? So here we identify structure, market structure, what is happening. So I'll be looking at, again, I said 9:30. So the stock market, guys, Nasdaq indices, index futures. The stock market opens at 9:30 New York time. So 9:30, that's when you wanna start looking at things like Nasdaq, US 30, US 500, and then from 9:30 to 10 o'clock. Wait, 10 o'clock. 10 o'clock is here. You don't want to do much trading in the first 30 minutes because in the first 30 minutes, that's when um, the Judas move is at. So the first 30 minutes is most likely to be a false move. So you don't want to look at that move, or rather that the first 30 minutes. So obviously, guys, you want to see liquidity being you want to identify a stop rate. So you want to see liquidity being collected. So at 10:08 we had a low formed, a swing low. As you can see, we have a low on the left, on the right, and a lower low on the left. So we have a low that has a low on the left and a low on the right. Ne? That was formed at 10:08. This low, it was violated at 10:23. So when something like that happens, that's what we call a stop rate. A stop rate is basically price trading below the low here. So we had a short-term low, price trades below the short-term low. So all these candles, that's a stop rate. We see price creating a swing high here at 10:26. We see price creating a swing high. In other words, it is a high that has a lower high to the left and a lower high to the right. So this high here, that's a swing high. We see it being taken out here with displacement. So we see price taking out this swing high with displacement. It's leaving a fair value gap. We have another swing high here and another one here. So one, two, three swing highs get taken out with one displacement move to the upside. So all these candles, they're moving impulsively, taking out all these highs. So when something like that happens, we call that a market structure shift. So a market structure shift is basically when a swing high gets taken out with displacement. Displacement means impulsively. We see a fair value gap being formed in price. In other words, the high of this candle and the low of this candle, there's a gap in between these two candles. So that's an imbalance in price. Price would want to trade with that and fill that in the future. So when you see a fair value gap being formed here after taking out a swing high, after collecting liquidity, that's called a market structure shift. So in this case, it's going to be a bullish market structure shift. But if it was a bearish scenario, that would have been a bearish market structure shift. Then you enter the fair value gap and you target untapped liquidity. So what does that mean? When we opened initially at 9:30, we moved higher a bit, left a swing high here. So in other words, when price was trading lower to take out this low and form this low and then take it out as well, there were people that were selling this. So people who were selling this, they will put their stop loss above the previous high. So they will feel very safe putting their stop loss above this high. So we know there's stop losses resting above this high. What kind of stop losses? Well, buy stops. So if someone is selling this, they'll put a buy stop to as a protective measure. And then okay, yeah, I think I explained it clearly. So I'm gonna go ahead, guys, and put the lipstick on my chart so that I can express myself. So for the first part of this video, all along I've been expressing myself using words. So now I'm gonna use these symbols and trend lines and all those things to communicate what I'm trying to say to you. Ne? So these things that I put here, they mean no difference. Everything that happened in the AM session for this morning, I basically just said it. Okay, before I put on the lipstick, let me conclude. Market structure shift, fair value gap. We see price trading to the fair value gap. and then at 11:02 it leaves as expected. So I'm gonna go ahead and put in the details. So 9:30 again, this candle is marked as the stock market opening bell. So at 9:30 the stock market opens. The first 30 minutes is the Judas swing. So we see market um, creating a swing high here and then rallying lower. Sell side liquidity below this low gets taken out here. So any form of trading below this low would be regarded as a stop rate. So this box that I'm marking now, that's a stop rate. So anything happening here is a stop rate. With a swing high here, it gets taken out impulsively. That's a bullish market structure shift. With a fair value gap here, price trades back to the fair value gap, as you can see. It finds support at the order block, which is not within the scope of this video because I'm teaching fair value gap. For this model, you're looking at the fair value gap. So as soon as price trades to the fair value gap, you could be very comfortable buying that immediately. So if you're new to this concept and you still want to practice, so in your demo trading, in your practicing, you can buy that immediately as it enters the fair value gap here, and you put your stop loss below the low, below the candle that created the fair value gap. So you put your stop loss below, this swing low, basically below the stop rate. You could even be comfortable putting it below this candle that created the fair value gap. As you can see, price doesn't trade to that. So if, like I said, if you're new, you can enter there. The more you get used to this concept and you 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 use them in conjunction with other concepts as well. So let's say now you're still learning fair value gap. The more you learn about order blocks, you could enter another entry at the order block, this order block there. So you can enter a buy there, stop loss, same stop loss, or you can enter a buy at this order block, and lastly this order block. Like I said, the more you get used to this concept, you can refine your entry. But now, while you're still learning, just wait for the fair value gap and then enter as soon as it enters the fair value gap. Stop loss below the low there, the first initial low. Then you target liquidity. So like I mentioned, there's buy side liquidity above this high. In other words, people who are selling this, they will be very confident putting their stop loss above this high. So you target the stop loss for 3 to 8. Then you can see price trading to your take profit day at 11:47. You don't have to be greedy and hold the whole move. Like I said, like I'm trying to show you here, end of New York session 12 a.m. 12 p.m. So in this example, by then you'll have been already out of the trade. Now let's say if you happen to miss this trade, or if you are not sure that price is gonna react to this fair value gap and then price lower. 11:05. So between this candle here, the high of this candle and the low of this candle, there's an imbalance in price marked by the blue gap. So when that happens, we call this a fair value gap. So you see price trading to the fair value gap using this candle at 11:08. So when that happens, you could buy there. Let's say you missed this entry here, this initial entry. You could be very comfortable and confident buying that, putting your stop loss below this swing low, because if price is in a buy program, remember this bullish market structure shift, that's telling you price is in a buy program. So if price is in a buy program, when market creates um, discount fair value gaps for you. You wanna buy them, so buy discount. Market prices higher, fair value gap again. As soon as price trades do it, you can be comfortable buying that. Or if you already bought initially here, you could add more trades. So using discipline, obviously, and risk management, you add more trades. So you are adding to a winning position, unlike a typical retailer who adds to a losing position. So you're adding to a winning position, huge fair value gap here. Price trades to it the first time, you buy that. Price consolidates. So from 11.21 we create a high, and then 11.23 we create a low. Price consolidates, so price is range bound, is trapped in between this high and this low for a long time, up until 11.41. So for like a couple of minutes, price is consolidating, so it's collecting more orders. Price is basically market makers, they're inducing more liquidity. So as you can see, we have a low here. They take out this relatively equal lows. Smart money buys that. So this heavily gap, smart money buys that. Order block, trace with the order block perfectly there. Smart money buys that. Then they push it higher. So this was the buy side liquidity that you're targeting. It gets taken out here with a big candle, which leaves a fair value gap. Your target has already been met, but you're still trading in the times. So you're still in the New York session up until 12 a.m., 12 p.m., sorry. So I'm looking at the midpoint, no, the midpoint of this fair value gap. So the consequent encouragement of this fair value gap, the midpoint of that, smart money was gonna buy that. So at this price, 4244, 4244.6, smart money will buy that, which is the midpoint of this fair value gap. So let me just put up so that I can show you. So this fair value gap that I marked for you right now, the midpoint of that, smart money will buy that, because it's still in between. We're still in the New York session, right? 10 minutes left, so they'll buy that, and then at 12 o'clock they'll be out by then. So when price takes out this high, I think most of the smart money trades will be off the table, because so the more highs, so if we're bullish, the more highs they break. So we create a high here. When they break it again, they're exiting. Breakout artists, retail traders, they like to buy the breakout. So when they buy the breakout, smart money is actually closing their sell trades. So smart money works on time, guys. At 12 o'clock, they're done trading. End of the New York session, that is the beginning of the New York lunch. So during the New York lunch, smart money is not trading. So as a quick recap, if you perhaps missed the goal that I just shared with you during this video, this collection of sell side liquidity, swing high here, displacement, market structure shift, this happens every day. It happens every day. Obviously, I mean that sometimes it can be a bearish scenario. So on this day, it was a bullish scenario, sell side liquidity being taken out, bullish market structure shift. So on other days, you'll have buy side liquidity being taken out, swing high, bearish market structure shift. So on this day, it was bullish. On another day, it will be bearish. Nevertheless, this happens every day. So it's a good model to look at. So let me just show you the instructions one more time before I close the video. Easy everyday ICT model. During the New York session, identify a stop rate, wait for market structure shift, enter the fair value gap, and target untapped liquidity.